Hey everyone, welcome back to the channel. Today we're diving deep into a topic that's been generating a lot of buzz lately, especially among investors, economists, and anyone paying close attention to the global financial system, and that's the possibility of a major gold revaluation. Now, before we get into the details, let's just take a second to understand what we mean by gold revaluation. In simple terms, this refers to a significant upward adjustment in the official or market value of gold, either through market forces or as part of a strategic move by governments or financial institutions. And depending on who you ask, we're not talking about a small bump here. Some experts are floating numbers as high as $15,000 per ounce. That's right, 15,000. Others are taking a more conservative approach, suggesting a more modest but still dramatic increase to around $8,000 an ounce. Then there are projections that fall somewhere in the middle, like those from Goldman Sachs, which peg future prices at around $3,700 per ounce by the end of 2025, and possibly up to $4,000 by mid-2026. So, what's really going on here? What's driving this speculation? Why are analysts, central banks, and even governments quietly shifting their focus toward gold? And is a revaluation actually likely, or just another round of hype? Let's break it down step by step. First up, debt management. One of the biggest reasons gold revaluation is being talked about right now is because of debt, specifically the ballooning national debt of countries like the United States. Now, the US holds a significant amount of gold in its reserves. If the value of gold were to increase, especially in a dramatic, controlled way, it could suddenly make those reserves worth much more in dollar terms. That would strengthen the government's balance sheet and potentially make it easier to manage or offset the growing mountain of debt. Think of it this way. If you owe someone a huge amount of money and you're sitting on a pile of gold that suddenly triples or quadruples in value, that changes your financial picture overnight. It's not a fix-all, but it's a powerful tool, and some analysts believe this is exactly why a revaluation might be quietly on the table behind the scenes. Next, monetary policy shifts. This is where things start to get really interesting. There's increasing chatter about a potential shift in how the US and other countries might approach monetary policy going forward. We've all lived through an era dominated by fiat currencies, money that's not backed by any physical asset, just trust in the government or central bank that issues it. But that trust has been getting tested lately. Inflation, rising interest rates, and concerns about currency devaluation have a lot of people rethinking the system. So what if, just what if, there's a move back towards something more stable, like a gold-backed system? Now, I'm not saying we're going full gold standard again, but there are whispers about a hybrid approach, a system where gold plays a much more prominent role in backing or stabilizing currencies. If that shift were to happen, or even just be seriously considered, the demand for gold would skyrocket, and with higher demand comes higher prices, plain and simple. Third, geopolitical instability. You can't talk about gold without talking about global instability, and unfortunately, there's plenty of that going around right now. From the war in Ukraine to ongoing tensions in the Middle East, to shifting alliances and trade disputes across Asia and beyond, the world feels more uncertain than it has in decades. And in times like these, investors and even entire governments look for safe havens. That's where gold comes in. Gold has always been seen as a safe asset. When everything else feels like it's in chaos, whether it's stocks, bonds, currencies, or even real estate, gold tends to hold its value. In fact, it often gains value. So it's no surprise that in this climate we're seeing a renewed interest in gold from all corners of the globe. That includes not just individual investors, but also central banks, which have been quietly but steadily increasing their gold reserves over the past few years. Next up, supply and demand imbalance. Here's a simple truth. If demand keeps rising and supply stays the same, or even shrinks, prices go up. And that's exactly what's been happening in the gold market. Mining new gold isn't easy. It's expensive, time-consuming, and subject to all kinds of geopolitical and environmental challenges. On top of that, many of the major gold mines around the world are seeing declining output. There just isn't as much easily accessible gold left in the ground as there used to be. Meanwhile, demand is going up. We've talked about investors and central banks buying more gold, but there's also increasing industrial use. Think electronics, medical tech, even some aerospace applications. When you combine rising demand with constrained supply, you get upward pressure on prices. And some analysts believe that this growing imbalance could be a major driver of gold revaluation in the near future. Basel III regulations, a silent game changer. Now here's something that doesn't get nearly enough attention in the mainstream media, but could have a massive impact. Basel III. If you're not familiar, Basel III is a set of international banking regulations that, among other things, change how banks treat gold on their balance sheets. Under these rules, physical gold, that is, real gold that a bank actually holds, is now considered a Tier 1 asset. That means it's seen as just as safe and reliable as cash or government bonds. But here's the kicker. Gold held in derivative form, like paper contracts or unallocated gold, doesn't get the same treatment. This creates a clear incentive for financial institutions to move toward owning actual physical gold instead of just paper promises. What does that mean for the market? Potentially a massive shift in demand from paper gold to physical gold, which again could put serious upward pressure on prices. Unwinding derivative positions. Let's talk about derivatives for a minute. Specifically gold derivatives. These are complex financial instruments that allow traders and institutions to bet on the future price of gold without actually owning any physical metal. For years, this paper gold market has been much larger than the physical market, and many believe it's kept prices artificially low. But that might be starting to change. As more institutions move toward physical gold, and as regulations tighten, we could see a massive unwinding of these derivative positions. That means traders and banks closing out their contracts and potentially buying physical gold to cover their positions, which could cause a sharp spike in demand and in price. That's a lot to unpack, and we're just getting started. In the next part of this series, we're going to dig into the different price targets being floated by experts, what those numbers are based on, and what it could actually look like if gold did revalue to something like $8,000 or even $15,000 per ounce. Now let's shift gears and get into the nitty-gritty. Welcome back for the final part of our deep dive into the gold revaluation discussion. So far, we've looked at the driving forces behind the speculation, and we've gone over the different price targets experts are predicting, from the conservative $3,700 per ounce all the way to the bold projection of $15,000. Now, let's get into the what-if part of the conversation. What would a gold revaluation actually look like? How could it unfold? Who benefits? Who gets hurt? And most importantly, what can you do to prepare if it does happen? Let's unpack it. Scenario 1. Gradual market revaluation. The first possibility is a slow, steady climb in the price of gold, driven mostly by fundamentals. This scenario is already playing out to some extent. We've seen gold quietly rise over the past few years, largely driven by central bank demand, retail investor interest, and macroeconomic concerns like inflation and debt. In this case, we might not see any dramatic announcements or major policy shifts. Instead, the price could just keep rising organically as more people lose confidence in fiat currencies and look for a hedge. This is the kind of movement that brings gold to $4,000, $5,000, maybe even $8,000 per ounce over the next several years. For most investors, this would be a positive outcome. If you already hold gold, you'd see a healthy return. If you're dollar cost averaging in slowly, you're building a hedge over time. And it gives people time to react, adjust their portfolios, and consider precious metals as part of a diversified long-term strategy. But let's be clear, this scenario still implies some serious shifts in the global economy. It means inflation is persistent, fiat currencies are under pressure, and people are actively moving their money into tangible stores of value. Scenario 2. Sudden government-led revaluation. Now let's talk about the big one. What if there was a sudden coordinated move to revalue gold? Maybe not globally, but perhaps by one major economic power like the United States. This could happen in the context of a financial crisis or as part of a sweeping monetary reform package. For example, if the dollar were to be partially backed by gold again, even at a small percentage, the government would need to assign a much higher value to its gold reserves to make that system viable. We've actually seen this before. In 1933, during the Great Depression, President Roosevelt signed an executive order that revalued gold from $20 per ounce to $35 per ounce. That was a 75% increase, overnight, and while it seems unthinkable today, a similar move could be used as a tool in a future crisis. It would allow the government to devalue the dollar without outright saying so. It could reduce the real burden of debt, boost the value of national gold holdings, and potentially calm markets in the midst of a currency crisis. But here's the catch. A sudden revaluation could also trigger market chaos. Gold prices would spike. Investors who weren't already holding gold would scramble to get in. The value of fiat currencies could tumble, and confidence in the financial system could take a serious hit. This is a more extreme scenario, but not impossible, and that's exactly why some analysts are urging people to be prepared before it happens. Scenario 3. The paper gold collapse. This one is a bit more technical, but it's important, especially if you own gold in the form of ETFs, futures, or other derivative instruments. As we mentioned earlier, the paper gold market is estimated to be enormously larger than the physical market. Some estimates suggest there could be as much as 100 ounces of paper gold for every ounce of real deliverable metal. That's a huge discrepancy. If trust in the paper gold system were to break down, say due to regulatory pressure, a major default, or widespread demand for physical delivery, we could see a sudden and severe decoupling of prices. In other words, the spot price of gold as tracked on exchanges could collapse, while the price of physical gold on the street or through private dealers could explode. In this case, the winners are the ones holding real physical gold. The losers? Anyone holding unallocated, leveraged or synthetic gold exposure, which could end up being nothing more than a paper promise. This scenario is especially concerning because it could unfold quickly and leave investors with very little time to react. How would a revaluation impact the average person? So let's bring this down to earth. How would a gold revaluation, whether gradual or sudden, affect everyday people? Well, for starters, it could signal a major shift in how wealth is measured and stored. If gold becomes significantly more valuable, those who own it would likely see a substantial increase in their purchasing power. That's especially true in a crisis scenario where other assets like stocks, bonds, or even real estate might be losing value. It could also affect global currency values. If a major economy ties its currency to gold at a higher price, that currency could instantly become more stable, but also more expensive to trade. That could impact exports, imports, and the global balance of trade. And for the broader population, a revaluation could serve as a wake-up call, a sign that the financial system as we know it is changing, and that old assumptions about money, inflation, and value need to be re-examined. So what can you do to prepare? If you're watching this video, you're already ahead of the game. The fact that you're even thinking about these issues puts you in a small but growing group of people who are paying attention to long-term financial trends. Here are a few practical things to consider. Educate yourself. Further, learn the difference between physical and paper gold. Understand how ETFs work, what allocated versus unallocated means, and why owning the actual metal could make a difference in a crisis. Diversify your holdings. Gold is one piece of the puzzle. Think about how it fits into your overall portfolio. Precious metals can be a hedge, not necessarily a bet on the end of the world, but a way to balance out risk in other areas. Consider physical ownership. For those serious about protecting wealth, owning physical gold, coins, bars, or bullion stored in a secure vault can provide peace of mind. Just make sure you understand the storage and security implications. Watch central banks and policy signals. Pay attention to what the world's biggest financial institutions are doing. If central banks are buying gold hand over fist, that should tell you something. If new regulations are pushing banks toward physical reserves, don't ignore it. Stay nimble. No one knows exactly how or when a gold revaluation could happen, but staying informed, flexible, and ready to adjust your strategy is key. If the signs start pointing to a major shift, You want to be proactive, not reactive. Final thoughts. Look, we're not here to predict the future with absolute certainty, but the signs are there. Debt levels are unsustainable. Trust in fiat money is slipping. Gold, a centuries-old store of value, is making a quiet but powerful comeback. Whether gold goes to $4,000 or $15,000 an ounce, the bigger story is the role it's starting to play again in global finance. A revaluation might not come with a loud announcement. It might unfold slowly, in headlines and central bank policies and subtle shifts in investor behavior. Or it could come suddenly, in a flash of crisis, leaving those who weren't paying attention scrambling to catch up. So the real question isn't will gold revalue? It's are you ready if it does? If you found this video helpful, give it a like, drop a comment down below with your thoughts or questions, and don't forget to subscribe for more deep dives like this one. Thanks for watching, and as always, stay sharp, stay informed, and stay prepared. Alright, welcome back. If you've made it this far, you're already ahead of the curve when it comes to understanding the forces driving this gold revaluation conversation. In part 1, we broke down the macroeconomic and regulatory factors, debt management, geopolitical instability, Basel III, and more. Now let's shift gears and get into the nitty-gritty, the price targets. We're hearing a wide range of numbers from experts across the financial world, and while they may seem bold or even outlandish at first glance, when you dig into the logic behind them, they start to make a lot more sense. Let's go through them one by one. The big one, $15,000 per ounce. Yep, $15,000. That's the high-end estimate making waves, and while it might sound extreme, it's not just some wild guess pulled out of thin air. Analysts like Craig Hemke and Clive Thompson have been vocal about this number. They argue that a revaluation to this level could be used strategically by governments, particularly the US, as a tool to reset or rebalance a debt-heavy financial system. If gold held by the US Treasury were suddenly worth many times more, it would dramatically strengthen the national balance sheet. Now, imagine this scenario. The government announces a significant revaluation of its gold holdings. Suddenly, the dollar value of those reserves skyrockets. That could help instill confidence in the currency, reduce debt-to-asset ratios, and even provide a lever for future monetary policy changes. There's also talk about what a move like this could do for the broader metals market. A gold revaluation at that level could spark a massive boom in other precious metals, silver, platinum, palladium, as investors rush to gain exposure. But here's the kicker. For gold to be revalued to $15,000 an ounce, it would likely require some sort of systemic shift, whether that's a partial return to a gold-backed monetary system, a major currency reset, or a global agreement on rebalancing reserve assets. Is it likely? That's still up for debate. But it's possible, and more people are taking it seriously than you might think. The middle ground, $8,000 per ounce. Now let's talk about the price point that seems to be gaining a bit more traction among analysts who are optimistic, but not quite in the radical reset camp. That's the $8,000 target. Market watchers at Discovery Alert, among others, have floated this number as a more realistic fair value based on fundamentals, especially supply and demand. Let's remember, the global gold market is a lot tighter than it looks on paper. When you strip away the noise of derivatives and ETF flows and look purely at physical supply versus real demand, from central banks, investors, and industries, there's a growing squeeze. Gold production isn't ramping up, but demand is. If those trends continue, and especially if physical gold becomes more desirable than paper gold, which, as we discussed, is already happening thanks to Basel III and other regulatory shifts, it could push prices dramatically higher. The $8,000 mark doesn't require a full-blown monetary overhaul, but it does assume that gold reclaims a more central role in financial markets. It assumes sustained demand, tighter supply, and some level of global economic uncertainty, which, let's be honest, doesn't seem to be going anywhere anytime soon. This price point is viewed by many as the bridge between today's market and a potential future where gold is more directly tied to sovereign financial health. The conservative projection, $3,700 to $4,000 per ounce. let's bring it down a notch and talk about the more mainstream institutional forecasts, namely what Goldman Sachs is projecting. According to their latest analysis, they expect gold to hit $3,700 per ounce by the end of 2025, and then potentially reach $4,000 by mid-2026. This is based on a variety of factors, including inflation expectations, interest rate movements, and ongoing central bank buying. Goldman's take is more in line with how traditional financial institutions look at the commodity, not as a monetary weapon or systemic reset tool, but as an inflation hedge and a portfolio stabilizer. From this perspective, gold's value grows alongside global uncertainty and investor caution, but within the existing financial framework. And honestly, even that forecast is pretty bullish by historical standards. Remember, just a few years ago, gold was trading in the $1,500 to $1,700 range. A move to $4,000 per ounce would still represent a more than doubling of price, which would be a huge deal for investors. But wait, why aren't we hearing more about this? Now, here's where things get a little strange. Despite all these forecasts, debates, and the growing interest in precious metals, the mainstream media has been relatively quiet about gold. Sure, you'll see the occasional headline when prices break records or when there's a dramatic spike, but compared to other financial narratives like crypto, tech stocks, or housing, gold barely gets a mention. Why is that? Some analysts believe this silence is strategic. They argue that if the general public were more aware of what's happening behind the scenes, especially in central bank policy and global gold buying, it could trigger a wave of retail demand that would overwhelm the market. Others say it's just the nature of media cycles. Gold isn't as flashy or disruptive as AI stocks or Bitcoin, so it doesn't grab attention in the same way. But behind the scenes, the demand is very real, and the lack of coverage might just be creating a stealth bull market. Physical gold versus paper gold. What's the difference? This is an important distinction to make, especially if you're considering buying gold yourself. When people talk about paper gold, they're usually referring to financial instruments like ETFs, exchange-traded funds, futures contracts, or other derivatives. These instruments allow you to gain exposure to gold prices without owning any actual gold. Then there's physical gold, bars, coins, bullion, the real, tangible stuff you can hold in your hand. Now here's the catch. The paper gold market is much, much larger than the physical gold market. In fact, some estimates suggest that there are as many as 100 ounces of paper gold in circulation for every single ounce of physical gold available. That's a staggering ratio, and one that raises serious questions about how the market would respond in a true demand spike. If just a fraction of paper gold holders decided they wanted to convert to physical metal, it could create a massive shortfall, and that's where things could get volatile very quickly. This imbalance is one of the reasons why many gold advocates, especially those warning about revaluation, focus so heavily on physical ownership. They argue that in a crisis, only real, allocated gold will matter. The role of central banks. Let's not forget the major players in all this. Central banks. Over the last several years, central banks around the world, especially in emerging markets, have been steadily increasing their gold reserves. Countries like China, India, Turkey and Russia have been among the most aggressive buyers, while even traditional Western institutions are quietly building up their holdings. Why does this matter? Because it signals that these institutions, which usually play the long game, see gold as a key part of future financial stability. Central banks don't buy gold based on short-term price targets. They buy it because it's reliable, universally accepted, and free from counterparty risk. And when central banks start hoarding a specific asset class, it's usually a sign of something big on the horizon. So, where does all this leave us? In Part 3, we're going to bring everything together. We'll talk about what a gold revaluation could actually look like, how it might unfold, who it would impact the most, and how you, as an investor, or simply as someone who wants to protect their wealth, might want to start preparing.